Hej och välkomna till Pressträff direkt. Den här gången med Tethys Oil. Med hänsyn taget till den stora andelen internationellt ägande i Tethys Oil kommer presentationen nu att fortsätta på engelska. Hello and welcome to Pressträff Direkt, a broadcast that is a cooperation between Direct Studios, Investor Target, Stock Picker and the presenting company, Tethys Oil. As always, if you watch this live, you can interact with the management by asking questions, and you will do that in the live chat. Feel free to use English and Swedish, and we will deal with them at the end of the presentation. So with all the disclaimers under the belt, it's high time and an absolute pleasure to introduce Magnus Nordin, CEO of Tethys Oil. Magnus, welcome.
Thank you so much. It's a pleasure to be here. It's been a while, so I'm very glad to be back.
And it's great to see you. Magnus, so far you have issued a production update for January, delivered a full year result for 2023, presented new financial guidelines for 2024 and communicated a strategic review of your portfolio. So a busy start to this year. So what's next? Take us through your presentation.
Thank you so much. No, indeed, it's been a busy year, and 2023 was quite a busy year. Let me just remind you all, what we are. We are an oil company, a Swedish oil company. We are listed in Stockholm, but we have most of our production emanates from the Sultanate of Oman, by the Indian Ocean on the right side of the Hormuz Strait. We've been active here since 2007. We've been in production since 2012. During that time we produced some 40 plus million barrels of oil. We have distributed about 30 Swedish crowns per share cash to our shareholders. We continue to deliver oil to the tune of about 8,000 barrels of oil per day. I think last year we had something like a turnover about $1.3 billion, close to 1.5 billion Swedish crowns. And quite a healthy EBITDA of $72 million, almost, or about $750 million Swedish crowns. Of course, being an oil company, we do our accounting in dollars, and oil price, as you all know, is also quoted in dollars. So the only thing that's Swedish to us is actually the share price, given that we are quoted in Stockholm, and also the cash distribution, which we usually refer to on a per cash basis, crowns per share. It was a busy year last year, and most of the financials were quite healthy. Towards the end of the year, we did an impairment of our main producing assets, blocks 3 and 4. Of course, this has no cash impact. It more reflected that the work program didn't really deliver enough results to warrant an increase in the book value of the company. Still, a very healthy and hefty $190 million in book value. Compared to our share price, which I think market cap today is about $110 million. A clear discrepancy, and that's something I suspect I will be asked questions about a little bit later in the presentation. And that actually brought on the strategic portfolio review. We have a number of assets in Oman. Blocks 3 and 4 are our main asset, where we are now currently have been in production since 2011, still producing 8,000 barrels of oil per day. That's down from before the pandemic. In 2020, we were close to 12,000 barrels of oil per day. We have added, since 2017, 3 additional blocks, 56, 58 and 49. These are earlier stage of the petroleum life cycle, no established production, exploration and appraisal. Let me get back to dividend and redemptions. It's been a mainstay for Tethys since 2014 to deliver cash distribution to our shareholders. And that has also been coupled by share buybacks from time to time when we've considered that to be an alternative way of distributing cash back to value back to shareholders. In 2023, or at the end of 2023, we decided that we will have to postpone the dividend decision. We could not take it in connection with the Q4 report. We are now looking at getting back to shareholders in time for the annual general meeting in May. A decision will have to be taken sometime by mid-April. And it will be influenced both by where we see the investment situation for the year, where we see production from 3 and 4, and of course the conclusions we can draw from the strategic review of our portfolio. We maintain a healthy reserve base. I mentioned that since we started production in 2011, we produced more than 40 million barrels. We still have just over 20 million barrels of 2P reserves, considerably higher if we look at the 3P, and not least if we also include the contingent resources. We had a very healthy reserve replacement ratio from blocks 3 and 4 for almost 10 years, when we found a lot more than we produced. And this is actually a number that investors should be focused on. It's a very important number, because I mean, if your reserves deplete and eventually you run out of reserves, and then you have no more company. But as long as you find more than you produce, you keep growing. And we left the growth phase from 3 and 4 about 2 years ago. We have seen increasing investments to try to turn that around, both in stabilizing the production, but also in getting the reserves back to a more closer to the 100% reserve basis. We foresee a fairly investment-heavy year in 2024. A lot of seismic studies have been carried out that are now being interpreted to unlock further value in the blocks. And with the stabilization of production, we have guided for a production somewhere along the lines what we saw in 2023 for the current year. But also, of course, we are trying to move forward and hope for 2025 should start seeing growth again. The impairment test is a direct consequence of increased investment and not replacing all of our reserves. The book value reflects the investment, less depreciation and depletion from production. And we did an impairment test by the end of the year, and concluded that the additional investments that we had booked to the asset in 2023 really weren't justified by the work that had been carried out. So we brought the value back in line to where we were about a year ago. So the 2022 and 2023 year-end book values on blocks 3 and 4 are pretty much the same. Key activities on 3 and 4 remains on the stabilizing production side. The green things here are the producing fields, and the red lines outline where we have spent almost $100 million on doing seismic for a 3-year period. As that seismic is matured and interpreted, we hope to find new oil fields, of course. Environmentally friendly investor, the operator of 3 and 4 has also commissioned a gas-to-power project. It's basically where we use the little gas that is part of the oil we produce, and instead of buying diesel to power diesel generators to drive pumps and maintain the electrical infrastructure of the fields, we're now going to use the gas we get from the oil, which is going to lower the overall both costs and carbon footprint. Leaving our non-operated producing 3 and 4, let me get into our block 56. This started out as an exploration block, that's to say when you start to look for new oil fields. We are surrounded, or I should say, we have adjacent oil fields. All this green stuff here are producing fields right next to our block 56. So from a trendology perspective, it wasn't too difficult to just assume if there is oil on the left-hand side of that yellow line, there would also be oil on the right-hand side. And so it's proven to be. So over the last couple of years, Tethys has invested some $40 million, I think, into Block 56. We have 4 oil discoveries that are now being appraised. We did a long-term production test from our main discovery, the Al Jumd field, last year. And we are currently compiling all this data into a document called a field development plan. That will be the basis for declaring the block for commercial production, and then we should be off to slowly start building production from this block. And of course we see that as a growth opportunity that eventually will replace 3 and 4 once the growth phase in 3 and 4 is over. Exploration has its excitement. Block 58, whereas Block 56 is now more of an appraisal opportunity. 58 is very much of a classical exploration opportunity. One well can find 100 million barrels of oil. Just to put in perspectives, I mean, that's 5 times more than reserves we have today, and more than double the amount of oil we produced for the last 10 years. The risks are accordingly. We're probably looking at less than 1 chance in 5 that we're going to find something here. But if we do, it could be quite transformative for Tethys, and in particular this area of Oman. And we just announced about an hour ago that we just signed a rig contract, and we expect to start drilling here towards, in April, towards the later part of April. And the risk-reward on this one is probably the best we can offer for the year. We've guided on production and finance, heavy investments, both in 3 and 4, but also a bit of investment in 56, and of course drilling a well in 58. And production we expect to be in line with what we saw during 2023. So stable production outline, quite a bit of investment in 2024, and aimed to continue to get us back into growth in 2025. So a little bit, we've come from harvest with a lot of cash distribution to investment, and that investment should create growth of both production and reserves, and then we should go back to harvest again. For the near term, drilling of 58, of course, field development plan for 56, monthly production guidance, production reports for 3 and 4, and everything else that it takes to be an oil company. So thank you for listening to this introduction to Tethys, and now I'll be very eager to hear what difficult questions Carlo may have.
Well, thank you for that, Magnus. We have a lot of questions that we have received, and there may be questions from the viewers, so we will take the viewers' questions up on the fly. But first, let me just ask you, the strategic review, what initiated that?
Well, I mean, from time to time, you always want to make sure that you have a well-balanced portfolio. And but this is also driven the fact that, as I mentioned, I mean, we have a book value of 3 and 4 of 190 million. We have an additional $50 million in the books for our exploration assets, and we have a market cap that is almost half of that. So something is clearly wrong. Either the market doesn't appreciate the value, it's a communication issue, or but it's certainly something we have to look into. What can we do to rectify that situation? What can we do to make the values more visible? And how can we possibly rearrange the portfolio to get a better understanding of what we're doing?
And the devil would be in the details, I take it, but rebalancing the assets, does that mean you can divest, or could you expand on that, or will you shift capex, or how should we?
I mean, all of the above. All of the above is possible. I mean, a strategic review is exactly that. We are looking at the strategy, we are looking at the asset portfolio. Block 58, for example, we are in talks about a possible farm down. We have 100% today. We may, if a partner, another oil company, would be interested in joining us and paying for the well, say, we'd be interested in possibly giving up part of our interest. Blocks 3 and 4, of course, we have a production stream. How can that best be put to use? I mean, all of these questions will be addressed, they will be examined, and a conclusion will hopefully be reached.
And perhaps a very exciting document to take part of, I take it.
Or a set of exciting actions.
And the timeline for this, was this April or?
We have suggested that it should be, that we should have a clear idea of where we are going in time for the AGM in May.
And that's a good segue to the next question, which is the board decided to defer dividend, but as I understand it, you maintain your dividend policy. So my interpretation here is that one shouldn't be, well, too upset or excited or whatever, because what you do your strategic review, and obviously in doing that you have to look at everything, because you may be investing more, but the dividend policy will not change.
No. I mean, we were still committed to distributing cash, as has been one of our guiding stars throughout our producing life. So this is a temporary rebate from what we've been doing in the past. There's still a possibility. I mean, as I said, we are reviewing that also. We have deferred the decision, and we will get back to shareholders and everybody else when we have a clearer idea of how we see both our cash needs, our financing needs, and how we would see the optimization of our portfolio move forward.
And then the impairment charge, or the write-down as it were, had an effect on the share price and the market. But if we look at the cash flow and, let's say, operations, how much of an impact did it have?
No, I mean, it's a non-cash item, of course. So and it reflects the higher investments in 3 and 4. I mean, we have talked about and we saw underinvestment for several years. There's been a partly painful catch-up, where we also have had to increase investment to the point where we are now building cost pool again. As to say, we are not getting all our investment back in the same year. And that, having also had a focus on infrastructure, this gas-to-power project, for example, and but little reserve addition, as you've seen, and all in all, the model showed that we were better off taking an impairment. And as I say, we brought it down to 190, which is a value we believe is quite fair for the asset, and it basically puts it back where it was a year before.
And you had a slide there, gas to power, and I have to expose my ignorance here. It's a fairly new expression to me, but as you describe it, it seems pretty obvious that one should do this. Next phase in 2024, when and how many phases do you have to go through before this is up and running?
Oh, it is up and running, and it's the first phase. I mean, the first fields and wells that have been connected, and now it's just a matter of expansion.
Okay.
So it will be expanded for the next 18 months until everything that can be electrified this way is electrified that way.
Okay. So basically, what one can look forward, it would be a cost reduction of the diesel cost.
Indeed.
Which seems like a pretty smart thing, and if it's environmental friendly, it's a double win, I think.
Indeed.
And if we look at the reserve replacement ratio, that is down to 32%, and you increase your investments, where would you like to be then in 2025, or what do you want the market to be looking for? Because 2024 is still a year of let's say, recovering, if I understand it correctly.
No, I mean, our aim is, of course, to grow. We still believe, and maybe this is a good time to say that also, I mean, we still believe that there will be a market for our product, for oil, for the foreseeable future, and the foreseeable future, I say, at least for the next 10 years. And clearly, we need alternatives. I mean, let us not forget that the world is consuming more than 100 million barrels of oil every day. In our modest way, we have produced 40 million in 10 years. And we are certainly not a large company, but I mean it is not sustainable to keep growing oil production. Eventually prices will become prohibitive. So we certainly need all the alternatives. But that does not mean we can go from 100 million barrels to zero in 2 years. That's not going to happen. And we are in a part of the world where production costs can be quite low and where we believe oil can still be found in an efficient and friendly way. And that's why we continue to do it. So that said, we are certainly looking at growth. We would hope to see growth of reserves, both within 3 and 4 again, as the new seismic comes to market, or basically becomes interpreted, as the investments take effect. But in particular also from our other blocks. The moment Block 56 in commercial production, we can add some reserves there. We will then hopefully see growth both in this year and next year. If we have a major discovery in Block 58, that would move to outstanding growth. And our Block 49 is more of an unconventional situation, but that's also certainly something that warrants continued work. And that said, just to answer your question quickly, we may be in a bit of a break from the growth we have seen in the past, but it's certainly our intention to get back into growth mode and continue to grow the company.
And Block 3 and 4, work program for 2024, what would you like to highlight for the market there?
It's more of the same, really. It's a continuation. It's very much a continuation of 2023. About the same level, about the same focus on investments. Eventually we will see seismic costs taper off as we simply can't do any more seismic. We're also going to see the gas to power taper off a bit as we now are getting into up and running, and we're going to see costs come down there. But all in all, it's very much a continuation of 2024 and hopefully back in growth by 2025.
And now I need to expose my ignorance again here. What is the shareholder value difference between exploration and appraisal well?
Say risk. Exploration is when you drill a well into a potential reservoir, but you don't know if there's any oil there. An appraisal well, then you already have done the exploration phase. You know there is oil there, you just don't know quite how much. So that's the main difference.
So 19 appraisal versus 3 exploration, that's a good ratio.
Typically, though, of course, the risk-reward may be much better in an exploration situation.
Oh.
So that's what we are seeing for next year. But with more seismic interpreted, I think now we are not operating that block, but we would probably like to see more of a ratio between more exploration wells, maybe a little bit fewer appraisal wells.
Block 56, declaration of commerciality. Could you explain?
Yes. I mean, when you set out and do exploration on a new block, you have 4 to 5 years to do exploration, prove to the government that owns the oil that you find that there is enough oil here and we have enough good ideas that we can bring this to commercial production. And that's why we then have to compile all our data, put it into a plan, and persuade the government and say, this is good enough to make a new oil field that can stand on its own legs and generate value both for you, our host government, but also for us, the contracting company and our shareholders.
And do we have a time frame of how long?
We've communicated that we are looking at hope to have an FDP done by around late March, early April, and we are aiming for a declaration of commerciality by mid-year.
But that sounds like a seal of approval, a quality sign.
Well, it's in particular it's something that we see an opportunity to get production, get cash flow, increase production, increase cash flow, increase reserves, growth in the future.
And the Block 58, high potential exploration, you mentioned enormous amount of barrels of oil there, and you state you're in discussion with select group of companies. Could you elaborate a little bit of that? Is that a partnership or is it like infrastructure or what?
Typical say, I mean, we have 100%. And we have a potential target of 100 million barrels. And we have a well to drill. So if we can get a partner who will be interested in getting in, sharing the risk with us, sharing the reward, and possibly also them being involved in a development. Whereas a large oil discovery, of course, has an immediate impact on potential value and value going forward. It can also be associated with several years and large investments together. And to have a consortium can be an advantage. I mean, it's on our terms. We have the money to drill the well. We have 100%. But if we can find a suitable partner, that would be another oil company that would fit into what we want to do and want to share that vision with us, it could be a very good fit and it could make sense.
The key issues here for me when I hear you is that you have 100% of the field, and if you are accepting a partner, it's because it's too much to bite for you alone. So it's a very positive sign then for the shareholder.
Given the right terms.
Yeah.
I mean, you can also take the risk on the well and then try and get a partner afterwards. Or if the well doesn't work, well then you won't get a partner.
No.
Most likely.
Investments will be financed by cash flow, cash on hand and external debt, as you said on the last slide. Am I right to understand that you have a credit grant from an external source?
We have been in talks with a number of banks also to make sure that we will have necessary funds if we need them, and they are progressing well. And we are looking at the frame of somewhere around that.
So if I connect the dots here, and you're discussing with potential partners, you also have financial backing, so you have a good, let's say.
No, I mean, we have no debt at all today. We haven't had debt since 2015, I think, and we have about 28 million cash. We have a fairly hefty investment program. We also have to be prepared to invest after the declaration of commerciality to ramp up production quickly. That's nothing we have guided for now, but that scenario could come. And then we just want to make sure that if we need the money, we have it.
So you're prudent.
That's the idea.
Are you for sale?
Everything is for sale at the right price. What is the right price?
But it's not now, or?
Typically, I would say no, given that, I mean, for those of you who follow the shares, the share price, I mean, we are down, if not 50%, so almost 50% since November. And that's, of course, and we have a market cap of, what did I say, about just over $100 million, 110 maybe, and we have a book value in excess of 200. Of course, if someone comes and pays double book value, I suppose then timing doesn't really matter, it's more a matter of value. But we are open to suggestions, and certainly we are for sale at the right price. But that right price is certainly not our current market cap.
No, and also there's a lot of skin in the game for the management, I take it. So normally it's a question for the board, but here it is really a question for management.
Well,
and board.
it's of course the board. Now,
Yes.
I still own about just over 4% of the company. So obviously I'm very interested in how the company evolves. But of course, any sale of the company or any M&A or corporate transaction would be to be decided by the shareholders at a general meeting.
Which you are one of them.
I'm one of them, but just one.
Yes, well, Magnus, thanks very much for an educational and interesting, let's say, talk. And if anyone has more questions, who does one turn to?
Oh, I suppose, please send us an email or give us a call. I'm happy to answer if I can. If I can't, I have a number of experts within the company who can give much better answers than I can.
And to you who views, if you haven't already seen the corporate homepage, it's quite easy to navigate, so you will find the contact details there. Well, Magnus, an absolute pleasure. Thank you. And thank you for viewers, and we'll see you next time.